What if I told you Warren Buffett, the man worth over $100 billion, made his first $1 million before he was even 30? It sounds unbelievable, but it's true. While most people were still figuring out what they wanted to do with their lives, Buffett was already on his way to financial greatness. Here's the shocking part: he didn't start with billions. He didn't come from wealth. In fact, his first big break wasn't from a tech startup or a new gadget. It was from sticking to simple, old-fashioned investing principles that many people overlook. Buffett's early journey is a story of strategy, patience, and making smart, often unpopular decisions. In this video, you'll learn how Warren Buffett turned a small initial investment into a fortune by buying businesses with value, focusing on what others missed, and using a strategy that even the smartest investors often forget. We'll explore his unique approach to finding bargains, his obsession with moats, and how he used patience to let his wealth grow without rushing. Stay tuned, because the strategies you'll learn in the next chapters could change the way you think about investing forever. Ready to discover how Buffett made his first million? Let's dive in. Chapter 1. The Teenage Tycoon. Buffett's early betting on businesses. Warren Buffett's journey to his first $1 million didn't start in a fancy office or with big deals. It began in his teenage years, when he began investing in small businesses. At just 11 years old, Buffett bought his first stock, 3 shares of Citi's Service Preferred for $38 each. He sold them at a small profit, but it was his first taste of investing. He was hooked. In high school, Buffett started a small business by delivering newspapers. But it wasn't just about delivering papers, it was about learning the basics of business. He understood that profits came from work, smart decisions, and keeping costs low. By the time he was in college, he was already thinking like a seasoned investor. Instead of wasting time on trendy ideas, Buffett started to focus on companies with real value. Buffett's early investments were about more than making money, they were about learning how businesses worked. He realized early on that successful investors didn't chase trends, they understood the basics of what made a company valuable. His focus on learning first helped him develop a strong foundation for the wealth he would eventually build. Chapter 2. The Magic of Compound Interest. The snowball begins. As Buffett's investments grew, so did his understanding of one of the most powerful forces in finance: compound interest. He has often referred to compound interest as the snowball effect. The idea is simple. Once you make an initial investment, the returns on that investment begin to earn returns of their own. Over time, the growth becomes exponential. Buffett realized that the earlier you start, the bigger the snowball gets. By the time he was in his 20s, he had already built up a portfolio of stocks that were generating steady returns. The key to his success? Patience. Buffett understood that compound interest wasn't just about investing more money, it was about letting time do the hard work for you. The real magic of Buffett's strategy was in his ability to let his investments grow without rushing. While many investors were focused on short-term gains, Buffett was thinking decades ahead. As he once said, "Our favorite holding period is forever." This long-term mindset allowed him to build his wealth over time, without constantly needing to make risky moves or chase the next big thing. Chapter 3. The Secret Weapon. Buffett's investment circle of competence. While most investors try to diversify their portfolios as much as possible, Buffett has a different approach. He focuses on staying within his circle of competence, investing only in businesses that he fully understands. In the beginning, this meant that Buffett avoided tech stocks, even though they were all the rage in the 1960s and 1970s. Instead, he stuck to industries he knew well, such as insurance and consumer goods. Buffett's strategy was to focus on companies with predictable earnings and simple business models. He didn't need to know everything about every industry, he just needed to know the industries where he had expertise. His deep understanding of these companies gave him the confidence to invest for the long term. The result? Massive growth over the decades. This approach helped Buffett avoid the pitfalls of many other investors who chase trends without fully understanding them. As he often says, never invest in a business you cannot understand. By sticking to what he knew best, Buffett avoided major risks and grew his wealth steadily. Enjoying the video so far? Make sure to subscribe to our channel so you don't miss out on more insights from Buffett's journey to his first $1 million. Chapter 4. The magic of moats. Buffett's pursuit of market dominance. Buffett's secret to making his first $1 million was his obsession with companies that had a strong competitive advantage, which he calls a moat. A company with a moat is one that can fend off competitors and continue to make money for a long time. Think of it like a castle with a big, protective moat around it. Other companies can't easily get in. Buffett loved companies like Coca-Cola and American Express because they had powerful brands and loyal customers. Coca-Cola, for example, has one of the most recognized brands in the world, and its distribution network is almost unbeatable. Once Buffett recognized this, he knew Coca-Cola was a company worth investing in. He bought shares in 1988, and over the years, the stock soared. Having a strong moat gives companies the ability to weather tough times and keep growing. Buffett made his first million by focusing on companies that were not only profitable but also able to stay profitable for the long term. Moats aren't always easy to spot, but Buffett's ability to identify them gave him a significant edge. Chapter 5. The Power of Patience. Buffett's key to building wealth. Warren Buffett's wealth didn't happen overnight. One of the most powerful strategies Buffett uses is patience. He often says, the stock market is a device for transferring money from the impatient to the patient. This is why, even early in his career, Buffett was able to wait for the right opportunities, rather than rushing into investments. Patience is what allowed him to buy stocks when others were panicking. Here's an interesting fact. Buffett's first major investment was in a company called Berkshire Hathaway. He originally bought shares for $7.50 apiece. By 2023, each share of Berkshire Hathaway Class A stock is worth over $500,000. This incredible growth didn't happen by chance, it was a result of Buffett's long-term mindset. He didn't care about short-term market fluctuations. Instead, he focused on the long-term health of his investments. Our favorite holding period is forever, Buffett has famously said. When Buffett invests, he's not just looking for a good deal. He's looking for a company that will dominate its market for years to come. The bigger the moat, the more confident Buffett is in the company's ability to grow its profits over time. As he says, the most important thing to do if you find yourself in a hole is to stop digging. If you invest in companies with solid moats, you don't need to dig around for more risky investments. The moat will do the work for you. Don't forget to hit that subscribe button for more Buffett secrets and investing tips coming up. Chapter 6. The Value of Being Contrarian. Going against the crowd. Warren Buffett is famous for being a contrarian. He doesn't follow the crowd, in fact, he often does the opposite of what others are doing. This is one of the reasons he's been so successful. During market crashes, when everyone else is selling, Buffett is buying. He sees value where others see risk. Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." This advice is one of his most powerful strategies for success. In the early 1970s, Buffett took this contrarian approach when he invested in Washington Post stock. At the time, the company was struggling, and many investors were avoiding it. But Buffett saw something others didn't, a management team that had a vision for turning the company around. Over the next few decades, Washington Post stock skyrocketed. Buffett's willingness to go against the grain made him millions. Being contrarian isn't just about going against the market, it's about being patient and disciplined. Buffett teaches that successful investing requires a cool head, especially during times of panic or greed. By staying calm and sticking to his strategy, he's been able to make millions. His advice: the stock market is a device for transferring money from the impatient to the patient. Patience, combined with a contrarian mindset, is one of the key ingredients in Buffett's formula for wealth. If you found these strategies helpful, don't forget to subscribe for more.